And yeah, let's get started then. All right, so yeah, my name's Julian, and I'm the founder of Safeforge. And today we are going to today we're going to be talking going through various things. So going through some updates on how the project is going and where we are with everything. But before that, I'm going to start by talking about DCA. So, going to give a presentation on DCA, dollar cost averaging, which is a very, very common sort of investment strategy. Going to talk about its pros, its cons, how to do it, and then we'll launch into sort of what's been happening over the last 2 weeks at Safeforge. So yeah, let's get started then. Yeah, so when we're thinking about dollar cost averaging, yeah, I think the first thing that we need to really think about is we want to go back to this idea of time frames in investing. So if you think of sort of different investors, um, different types of traders, yeah, you have sort of different time frames from the ultra high frequency to the day trader, to the weekly, to the monthly, to the long term, to the ultra long term, right? So going from super short frequency type traders, right? People who hold for milliseconds, all the way down to people who are holding for, 3, 5, even 10 years, right? And the thing about sort of each of these different time frames is that each time frame feeds off the previous time frame. So we've got Eddie joining us. So each time frame feeds off the previous time frame. So it kind of works like um kind of works like like the way I like to think about it is like it's kind of like those big fish, right? With the little fish sort of basically feeding on the skin of the big fish. That's kind of how the market works as a whole. Because if you think about sort of like the intra-market time frame, so the time frame of the market between just the participants of that market, right? So you think about day traders versus day traders, it's a zero-sum game. Where if you make money, someone else has to be losing money. And so the way that people actually make money in the market, right? The way that people make sustainable money in the market is that they make money sort of trading off longer time frames. Because longer term investors don't really care so much about slightly higher prices, yeah? And this kind of trickles down all the way throughout the market. So what does this mean for a long-term trader? Yeah, which is what's going to get us to dollar cost averaging, which is what's going to get us to DCA, right? Um, well, as a long-term trader, someone who's sort of like investing for the long haul in the crypto market, you have to be somewhat aware uh that the market does fluctuate up and down, depending on sort of like things that you probably don't have a huge amount of interest on. And so a strategy that allows you to get around these problems is the dollar cost averaging strategy, right? Where you buy into the market not all at once, but you buy over it over a specific period of time. And yeah, there's several different ways of doing it. Dollar cost averaging is one of the, I guess, main standard ways. And I guess that's basically the idea, right? Basically, the idea of something like dollar cost averaging is that you buy into the market over time, so that you get away from these sort of like short run sort of fluctuations. Okay, so how does the process exactly work? Yeah, like what is DCA? So I talked a lot about sort of being a long-term trader, but what does it actually mean to DCA? So DCA is actually really, really straightforward. You pick two things, actually you pick three, but two things are basically key, right? So you pick how much you're going to invest and how often you're going to invest. The third thing that you need to pick is what you want to invest in. So for example, you can pick monthly and $10. So to DCA, you simply put $10 into your asset of choice every single month. And the thing about DCA, and the important thing about doing DCA, is that you're consistent and disciplined about it. So you're putting in $10, whether or not, and let's for the sake of the matter, let's for the sake of argument, let's assume that you're buying Bitcoin. Yeah, you put $10 into Bitcoin on the 1st of January. And then let's say Bitcoin goes down, you still buy $10 more of Bitcoin on the 1st of February. And then, let's say it goes up, it shoots up a lot, you buy $10 more on the 1st of March, and then you just keep on doing that over a period of several years until you've accumulated the amount of Bitcoin or whatever asset it is that you want. So yeah, so in concept, DCA is a very, very simple concept, right? It's a very, very easy thing to do. And I think that really leads into sort of like, I guess, much of its benefits, yeah, much of the pros of DCA. So the main power of DCA is that simplicity, right? It creates that discipline. I think one of the most difficult things about getting into investment is sort of making those decisions, because you have to make the decision to invest, to put your money into the market. But what you also have to do is you also have to figure out when the best time to invest is. And one of the things that that's a real difficult thing, right? Like when you have to invest every single, sorry, I'm sort of tripping over words a little bit, but so it's actually very difficult, because every time that you invest, every time you make a trading decision, if you're actively trading, or if you're sort of making a decision on that factor, on the basis of sort of like external factors, you have to sort of go through a lot of mental calculus before you can make those investment decisions. And so DCA removes that onus from you. And okay, you might say, okay, it's a very simple rule, right? Like, how can this possibly work? Is this, how can this possibly be beneficial? And I think the answer is that humans aren't designed to be good traders. Like, we as people, as sort of emotional beings, we're not designed to be strong, good traders, yeah? Really what we're designed to be is, we're very emotional traders, and emotional traders don't do well in the market. And so if you look at sort of like successful active style traders, successful active style investors, most of them have a system. And so, the system is not always correct, of course, but what it does is that it takes away the element of emotion from trading. And that's what DCA does for long-term investing, right? So, you already are a long-term investor. You don't want to spend a huge amount of time on your investment. And so what dollar cost averaging allows you to do is it allows you to come into the market consistently in a disciplined manner without you having to think about it. And I think that's the real power. The other thing that is important to emphasize is that dollar cost averaging is much better than buying a fixed quantity. Because, okay, like you might say, okay, maybe I can buy $10 of Bitcoin every month, right? But maybe instead I should buy one Bitcoin. Yeah, okay. It's pretty difficult to buy one Bitcoin. It's pretty expensive to buy one Bitcoin every month. But for argument's sake, you could buy one Bitcoin. Or let's say you could buy one ETH a month, yeah? And dollar cost averaging has been shown, it's been proven to be better than this sort of like what you might say quantity averaging. Because what happens when you quantity average is that you tend to buy high and you, well, not exactly sell, but you buy a lot when it's high and you buy much less from a dollar perspective when it's low. So dollar cost averaging allows you to sort of like smooth out sort of that issue where you are buying a larger quantity at a cheaper price. And then when the price goes up, you're still buying, but you're buying at a much smaller quantity. And so dollar cost averaging is better in that sense. It is possible that there's an improvement to this overall strategy where as the price goes up, you buy a smaller and smaller dollar amount. But once again, that causes some thinking, and you'd have to design a system around that. But that's something that could sort of like help sort of enhance these features a little bit more. What are the cons of dollar cost averaging? I think one of the big cons is that, and it's really interesting because Vanguard actually commissioned this study because, as I'm sure all you guys know, right, Vanguard is the largest sort of index fund provider in the world. And so a study commissioned by Vanguard showed that, especially when you're doing DCA over months, in general, and so this is not in all cases, in about like 60% of the cases, when you're investing a lump sum of money, DCA actually underperforms just putting it all in the market initially. And the reason for that is pretty interesting, I think. So there's two factors sort of in play here. So one factor is that DCA helps sort of smooth out sort of all the sort of fluctuations that are happening in the market. The other factor is that the market tends to increase over time. And so if you DCA over a long enough sort of time period, then the general increase of the market, the general sort of upward trend of the market tends to, you might say, sort of be a bigger effect than the smoothing of the investment. And so DCA doesn't really work as well when you've got a big lump sum that you can invest sort of immediately. But then again, of course, right? Like, and this Vanguard study was really commissioned for people who, had like, let's say, 10, 15, 20, $100,000. And the question is sort of like, well, do I put it in $1,000 chunks? Do I put it in all at once? What should I do with that? If you're a regular person with a regular salary and you're just looking to put your money away slowly, then DCA, works very nicely because it builds that discipline. So, just want to show you, I guess, a quick case study of how DCAing works and what it looks like here. So, what you can see here is basically two graphs, right? There's the Bitcoin price, and there's a chart of sort of what your value would be, your portfolio value would be if you DCA'd into Bitcoin. And what you can see, of course, is that the charts seem fairly similar, right? Like, so the value of the portfolio tends to follow basically the value of the price, right? The difference, and it's hard to see sort of with these two charts, is that over time, your peaks get higher and higher and higher because you're accumulating more and more and more. And so what this chart basically shows us, is that if you DCA'd, and I set this, there's a nice little app called like DCA into Bitcoin, but if you DCA'd $10 into Bitcoin over the last 7 years, right? So that's a that's a total of you DCA $10 into Bitcoin over the last 7 years. So monthly over the last 7 years, right? So that's about $800 or so. You would have gotten up to $14,000. So today your portfolio would be worth $14,000. And so that's a percentage increase of about 10x. And of course, Bitcoin itself has sort of swung massively over the last 7 years or so. But I think the really interesting thing there is that you avoid sort of most of these problems, right? You avoid most of this buy high problems. You avoid a lot of the volatility issues that are inherent in Bitcoin. And so, if you look at sort of like the charts, right? If you'd bought in at 2018, then the price would be basically similar to where you are today. So you would have not made 10x, you would have made maybe 2-3x. If you'd bought in at, early in 2017, you would have made a lot more. But the thing about DCA is that it smooths that cost over time. And so rather than trying to pick the peak of the market, the bottom of the market, right, and sell at the peak, you're just getting into the market consistently, whether it's a bull cycle or a bear cycle or some other or somewhere in between. And that in many senses is where the power of long-term investing comes in, because fundamentally at the end of the day, money is made during bear markets. If you invest during bear markets, then there's plenty of room to grow. If you invest during bull markets, there's not as much room to grow, but psychologically, it's much easier to invest during bull markets. And so that's kind of that power of the DCA, And so, I encourage everyone here to really think about sort of DCAing into an asset. And so I think the last thing that I'd say is that several important things that are really important to consider when you are DCAing. Asset selection is 100% key, right? So dollar cost averaging into something that isn't valuable is a real problem, because at the end of it you'll end up with plenty of it, but it won't be a good asset. So you shouldn't dollar cost average into altcoins, for example, that you're not sure about sort of like fundamental value, right? Because dollar cost averaging is fundamentally, in the long run, it's a long run strategy. It's a long-term strategy. It only pays off in the long term with an asset that is going up in the long term. So stay away from altcoins with this strategy. at the end of the day, you want to find something that has strong long-term potential. And, at the risk of sort of like sticking in a plug, something like Safeforge is a great place to DCA because, what we have is we've got a diversified portfolio of crypto. We're updating it all the time. And so even if something like Bitcoin collapses, right? So, this guy's got $14,000 in Bitcoin, but, Bitcoin might not always be the largest crypto in the world. With Safeforge, you're protected against those sort of swings. So you're not just protected against the swings in the market, which is what DCA does. You're protected against sort of fundamental shifts in sort of the value of various tokens against each other as well.